must be the first LO coming from an investor request as such directly. But obviously we would prefer to be the partner that actually provides the best liquidity and the best service, and hopefully in time we will be exclusive to them. You lend to a pre-vetted law firm that pre-vets the cases, and if the case is lost, it's covered by an insurance. So essentially it insulates Sandfield from the issue of NPLs. That results, actually, we were discussing about junior shares. So Sandfield will be at 100 of the loan to value, so zero's junior share. And this is mainly attributed to the fact that they don't have any losses. Now, that said, we always say that every investment is still a risk, however which way you mitigate it. So investors shouldn't take it as a zero risk. But what I'm saying is that it's a really interesting business model because it seems to limit the losses very significantly. So we're not in a hurry with new ones. If new ones come, awesome. If not, you won't catch me with a broken promise.
Welcome back to episode number 10 of the Income Insights podcast. I'm your host, Denny Neithardt, and alongside me, the man who kept his promise, obviously, and delivered a lender recently. Welcome to the show, Kimmo.
Hi, Denny. Hey, nice to be back. And thank you.
Yeah, how relieved are you that you didn't have to put up with any kind of bet, and that you finally communicated a new lender signing last week?
Yeah, it's good. I mean, yeah, we like to try and stick to the expectations. So yeah, we're happy, obviously. And we have another one coming as well, which hasn't been published, but we'll talk about it later, I think.
Yeah, that's a good point. So just very briefly, the agenda for today. Obviously, we want to talk about Ibancar. We want to learn how the deal went down, and also what their business profile looks like, what you like about them, what the terms of the collaboration are. Secondly, we're going to shift towards the new lender, which I think by the time we release this episode will not be publicly communicated by Income. I think it's scheduled for next week. So some spoilers and some treats for our podcast listeners. And then towards the end, we can also address some regulatory changes in Indonesia, if we have the time for it, which apparently will then also impact lenders such as Dana Rupiah and Dana Bijak. But we get there towards the end if we have some time left. For the time being, I would say we start off with Ibancar, obviously a Spanish company, well known in the industry, already made its appearance on Bonster and Juvo. So maybe from your perspective, you can talk a bit about their business profile, what it is exactly that they are doing, and also what you like about them from an income perspective.
Sure. Yeah, I mean, Ibancar, we had discussions with them for a long time. And as you mentioned, they've been on other platforms. So I think it's a little bit of a known profile company, especially for investors who've been there for a long time. Quite good performance overall. They've been profitable for a very long time, established business. And yeah, I mean, we started talking. We know there's some larger investor interest also in them, and that's how we got talking to them. It came through a common associate, and that maybe you want to look into them. And then, yeah, we started talking. Took quite a long time to get everything in order. Summer came in between. There's a lot of stuff, but overall, we got their profile. What they do is they issue loans in Spain. The car is a collateral there in their loans, in most of the time, as the name would imply. And yeah, I mean, they've already listed loans. The loans are about on Income. I mean, the loans are about maturities about 13 months, as I looked just the first batch. And yeah, I mean, we're very happy to have them. A normal lender, established lender from Spain, our first Spanish lender. They also have some plans on South America, as you can see already from our profile on our page as well. Maybe that's something we look in a later stage, but for now, Spain and yeah, hopefully we get to grow their book quite good.
Yeah. Every party involved is hoping or having most likely the same hopes and expectations. Maybe just to get right back to the start, can you be a bit more precise in terms of when and how the contact with Ibancar started?
Yeah, sure. There's a bigger investor who actually referred to us, and then they started talking. They happened to like income. I mean, the investor. They said they like the profile of the platform. They like the team. They like the junior share part. And then they just suggested that hey, if Ibancar would be listed, we would also be willing to put some money in, and then yeah, and that's what got us talking actually. So I would say it's must be the first LO coming from actually from an investor request as such directly. As a named LO. Obviously, investors want always good LOs, and we hear that all the time. When's the next coming? You know, can you get somebody who's known? But so this is the first one where we could actually meet the investor's request as well, which I'm very happy about.
One might assume now, listening to those elaborations, that maybe this investor wasn't particularly happy with Ibancar on those other platforms, because otherwise, why not use their assets on those platforms? Or maybe the Ibancar plan is to maybe search for platforms that can serve more liquidity. I'm not sure what the exact motive has been.
Well, I think overall, I mean, I don't want to say bad things about other platforms as such, but we can see that some of the platforms or one of the platforms they've been like Monster, for example, has had some tough time in lately, and we've seen other LOs also mentioning that hey, some things don't work, and that's also in terms of public discussion, it's open information. When you look at Telegram, for example, the generic discussions, then you see that people have had their questions there. So I guess it's a matter of, for every investor is to find where they like it. This is a institutional level investor. So I guess our approach with the skin in the game junior share difference is something that's attractive to them. And therefore they just thought, okay, let's upgrade to income from this. Now that said, we haven't discussed if Ibancar will continue listing on the other platforms. If they wish to do so, then that's totally fine by us. The claims are anyway separated, so you can't list on multiple platforms, right? So one loan per platform. So if they wish to use it as some companies do, several different platforms to kind of widen the funding mix, then we have nothing against it. But obviously, we would prefer to be the partner that actually provides the best liquidity and the best service, and hopefully in time we will be exclusive to them. So
obviously this would have been my follow-up question, if you have any knowledge in terms of how they proceed with those other platforms, if they're going to exit their exposure on them. But as you shared, you don't know at this time, or you probably can't disclose it. But maybe you can talk about, or can you?
No. I mean, exactly. I don't know, to be honest. It's up to them. So the best we can do on income side is to be as good as we can, and hope that they realize that we have the best liquidity for their business, and then that'll facilitate their transfer from those platforms completely. But not sure what the plan there is on their side.
Curious, obviously, in this background story, that the referral came from an investor, obviously someone with, let's say, someone that has slightly bigger investment volumes at hand. Didn't you personally have Ibancar on the list as a potential lender beforehand?
We have discussed with them years back. How many years been active, but still for a long time ago already. And I guess at that time they were relatively happy with what they were doing. And it's always a process for the company as well to start switching platforms. So we've had them in discussions, but now kind of it became concrete through this common associate, and we got it. We got it done, which is great.
Obviously, with a portfolio on Ibancar with 18 million, when we compare this to other lenders on income, it's obviously the second biggest lender. And I'm sure, like, transitioning also now to income, which I'm assuming is just, another resources that, they have to look at, setting up the entire infrastructure and make sure the processes work smoothly. I'm assuming they also expect, let's say, certain volumes on income. Where do you see the ceiling for them? Let's say short term, midterm, which volumes are you anticipating from them in the future?
Yeah, I mean, I think we could probably, well, I mean, let's start from where we are today. We're around 17 million total of outstanding loan books overall on income. I think we will be probably, with their help, we're going to reach around 20 by the end of the year. So I would be surprised if we don't. So I would assume that their plan in the short term is roughly 2 million, and then perhaps, growing up from there. As long as the business works, as long as they pass due diligence, we don't really have a ceiling agreed. So obviously for us to have an established lender who can absorb 5 or 10 million even, that would be great. But we usually start the discussion about, that we would like to see around 2 million in the relatively short term. 1 million is for the platform outstanding is roughly where it starts making commercial sense. So anything under 1 million is not very interesting. So yeah, 1 plus probably 2, 3 is doable in the short term, and then hopefully scaling it up to a significant size.
Now, looking at the terms of the collaboration, one thing that came to my mind was obviously a junior share of, let's say, only 11% is the lowest among all lenders that you have on income currently. Where does the confidence come from? What do you like about them in particular that make them, let's say, slightly better from your perspective, from your due diligence compared to other lenders?
Yeah. So it's good to repeat that the junior share is really not a question of the lender being better or worse. So we don't use it as a ranking tool as such. So that's just good to note. Where the calculation comes is their cash flows from the portfolio. So how much cash do their issued loans provide? And then that's basically what we're looking at. How strong is the loan book? And it means that if you issue today, or let's say this month you issue 100,000 euros of loans, how much came back in, for example, 12 months time? And you get a multiplier. Maybe it's 1.1, maybe it's 1.2. Then we add there some risk factors in, say like, okay, if we would need to collect from the book, maybe there's a 0.2 disappears to collection cost, maybe something like this, maybe the market weakens or whatever. And then we end up with the junior share number saying, how much buffer there has to be for the investors to be made whole. So that's the logic. Basically, you calculate the cash flow multiplier, as we also call it, and then you define the junior share from there. So in their case, it's simply it's a European market, first of all. So there's no FX risks, other things to say. So that's always a good thing. And then they just have a good book. So essentially meaning that their pricing is right, because part of the cash flow is obviously your interest and others. But also their collection and their non-performing loans are in the right level. And then it's a combination of pricing and defaults, and then essentially your underlying cash flow to those loans. And then that's how we ended up. So there's a certain methodology that Maciej is doing, and then we don't really agree like, hey, let's put it this way because we happen to like them. It's kind of a calculation-based logic with certain adjustments. Obviously, if we see there's an FX risk, we need to add an FX buffer. If there's incomplete data, we add an incomplete data buffer. So for example, incomplete data could come from if the loans are 2 years old or 2 years maturity, but for this new 2-year product, they only have a track record of 1 year. So the loan cycle is not complete. So we might say, okay, we don't think it's going to default on the last 12 months, but we also don't have a fact that it doesn't. So therefore, we add some sort of a risk margin in there which usually then increases the junior share. But overall, yeah, I mean, it is one of the lowest, but that's purely because their book is good and their pricing is good and their NPLs are low.
Which apparently makes them, in comparison, maybe slightly better to other lenders, which would be my logic behind. But yeah, I understand the way you phrase it.
Yes, correct. You could say like from a business sustainability point, obviously, the better the book, then the better it is. You could theoretically fund a loss-making book as well, which is not profitable due to defaults or pricing, but then the junior share would be just bigger, right? It could be 50%, for example. So that would mean that 50% buffer against every euro that the investor puts in. Obviously, this leverage level wouldn't be very attractive to any LO, but theoretically, with the same idea, you could do this. But yes, yeah, I think you're right in that sense that it is an attractive investment proposition.
Yeah. Quick follow-up on the NPLs. I recently read a public statement, I think it was from their CEO, which stated non-performing loans being at 3%. Is that a number that you can confirm?
I think I would have to turn to Maciej before I go there. But if it's public information, then I would assume that this is the level. If there is a car collateral, we're talking about something totally different than a non-collateral loans, obviously. Non-collateral loans in Spain have a extremely much higher NPL rates due to the problems of collecting. But they have managed to crack the market and they've been there very successfully for a long time. So good for them.
And another follow-up on the junior share. I was wondering, when you make your calculations and you say like, look, it's we would have a junior share of 11%. Is this like number set in stone, or does the lender then revert to you and say, look at our performance, please consider certain elements? So is there a room of negotiation for lenders as well when you set up the junior share?
On the underlying calculation, no, not really. It is what it is. We can, and we do sometimes, obviously, if it looks like it's not an attractive deal for them. In the end, it's a business and it needs to work for both sides, the LOs, us, and or let's say all the sides, and the investors as well. So the risk margins are something that we adjust sometimes. So, like I mentioned, the incomplete data, for example. Now, if we set it at 10, we can say, okay, well, maybe we can squeeze something off there let's take a look at it again. Or, if there is how would I say? We also have a general risk margin. So we might say, okay, this is a European market. We know it's probably easier to collect in there than somewhere else. So maybe this is something we can. So there are elements we can adjust, but these are not in the tens of percents. These are rather in the individual, like single digits, I would say. So in the end, the main calculation comes from the performance of the book.
But those discussions happen with lenders in the background.
They happen all the time. Obviously, I mean every lender comes to us, and the kind of the market standard has been the skin in the game of 5 to 10%, and that's what we're competing against as well. So we often hear that Mintos has 10%, for example, on all lenders, which is skin. And how can you guys ask 20%? And we say, well, it's a different approach. We think it's a winning approach, and it's how it should be done. And not undermining in any way what Mintos is doing. It's their business and they do things differently. They have obviously the larger loan originators. They have the security structure. So there's a lot of things that they do differently and perhaps even better as kind of the leader in the industry. But this is something that we often hear. Hey, this is too high because other platforms are offering this much lower. And then it's a discussion really like what's our comfort level, where we think we're still in the right place with that. while being able to provide them with with an offer that they can actually work with in their business. Every LO would like to get a 100% leverage on their book and be very happy about it, but we always can't do that.
And one more risk-related question. You pointed out that Ibancar is now expanding also to Mexico. To which extent does your risk assessment approach then differ, or how is the look at those kind of ventures differently when you have the lender already on the platform but wants to launch in new markets that obviously bring different risks altogether? But how much does the due diligence vary then on an income from the income perspective?
Well, I mean, they don't have any, we don't have any loans on the platform from Mexico, right? So when we have this sort of a loan book specific due diligence, then obviously before any loans would be listed from Mexico, then we would need to do our separate due diligence on the quality of those loans. There would need to be different assignment agreements, a different framework agreement with their Mexican lender, and so forth and so forth. So we usually look at it as a completely different case. So you don't have, the only thing that might kind of affect is that if there is a group structure where you have sort of a holding company that holds these other countries, and then you would, what is the effect on the holding company? What's the drain on equity and others? But these are more of like soft points, and these are, something that they will manage internally. We look at kind of okay, this is a lending business that seems to work. They can assign loans to the investors. We do a due deal, and if everything pans out, then they're there. Obviously, it's, you build trust when you work with them, and you see the track record and that everything goes well, then these things make it much easier to then onboard new markets for LOs. But the approach to look at the loan book, that remains the same.
Have you had any loose discussions already about Mexico?
No, we decided we'll do this first, and it took such a long time that I think we want to see now that their demand gets filled. So when they supply loans, so everybody who's listening who hasn't yet updated their auto invest, it's a good time. Go check it out. A small advertisement here. If the test goes well, then for sure we will look at the Mexico, but it's just as much in the investors' hands as it is in our hands in that sense as a platform. So,
security structure, classic SPV.
It's the same pretty much as everywhere. European company, so nothing much else but do assignments of receivables.
In terms of the maturities, maybe then to wrap up Ibancar. In the official communication was pointed out maturities can be up to 37 months. Now, I believe yes, the first terms that I saw were 23 months. Do you have any thoughts of maybe implementing an early buyback after 12 months to make it a little bit more liquid?
Possibly. We haven't discussed it with them yet. I mean, the first batch they listed was a tad above 12 months. So I think around 13, 14 months when I checked, that was the first. Now so I guess they're putting different maturities on and seeing also where's the demand. But yeah, I mean, we just wanted to get the basic thing done first, and then let's see how early buyback would work with them. So, but yeah, I mean, they list anything from between those maturities.
Okay. Yeah, then let's switch maybe to a new lender, which will most likely be officially presented next week. The name is Sandfield Capital. It's a UK lender regulated by the FCA, focusing on civil litigation funding, kind of a new niche that evolves that some investors might have come across already on Mintos with Nera Capital. I was reading through a couple of documents that have been shared with me yesterday. Maybe from your perspective, can you, because I think because it's a little bit of a different approach, it might be a bit harder to digest for investors to really get behind this topic. Can you maybe try in simple words to explain the business model that is underlying here?
Yeah, sure. So yeah, Sandfield Capital. So they're doing litigation lending, or if that's what the right term for it is. But essentially, they provide funding for or loans to law firms to cover for costs of litigation, right? So you would have somebody going to a law firm in simple terms and saying, hey, I have this case. Would you represent me in court against, whatever that may be? Is it a contract dispute, whatever, divorce, whatever it could be. And then essentially litigating incurs always fees, not the lawyer's fees, but other fees as well. There's court fees, all kinds of administrative fees and others. So now the end borrower, the individual going to the law firm, then this person doesn't necessarily always have the funds for that litigation. So Sandfield borrows to the law firms, and it's a set. It's not just any law firm. It's a set panel of law firms that they vetted, and they've done their due diligence on them, and they've looked at what kind of cases they've had and what's the performance of the cases and so forth. And then they are accepted as part of Sandfield panel, and then the cooperation starts. Now, the law firms in themselves also vet the cases. So they don't want to take just any cases to be funded. They take those cases to be funded where there might be, in their opinion, a good chance of winning it, right? So you have like multiple layers of vetting on it. Now,
I think
what makes
Sandfield, 1 second. I think the rejection rate was 70% from what I saw in the documents.
Correct. So they reject quite a bit of the cases. So and and the logic for the vetting on that side is also that these are covered by insurance. So the business model is very interesting. You lend to a pre-vetted law firm that pre-vets the cases, and if the case is lost, it's covered by an insurance. So essentially, it insulates Sandfield from the issue of NPLs. Obviously, if the case is won, then the loser of the case pays to the person who won it, or to the law firm, and then the money goes to Sandfield. So the loan gets repaid. So it seems to be quite an interesting business model, lending covered by an insurance. And now we're going to vetting once more. Even the insurance companies also vet the law firms. So they want to also see. So you have like multiple layers of due diligence on those cases. The insurance companies obviously wish to limit their losses, so or the claims coverage, and therefore they check it also. Now, and that results, actually, we were discussing about junior shares. So Sandfield will be at 100 of the loan to value, so zero junior share, and this is mainly attributed to the fact that they don't have any losses. Now that said, we always say that every investment is still a risk, however which way you mitigate it. So investors shouldn't take it as a zero risk. But what I'm saying is that it's a really interesting business model because it seems to limit the losses very significantly. And and we're very happy to have them on board.
Yeah, from the outside perspective, it sounds almost like pretty much bulletproof, but where would you maybe assess the underlying risk? Is it maybe something regarding the financials of Sandfield? And maybe you can elaborate also on those a bit. What's their track record?
Yeah, okay.
So far?
Bulletproof is a good comment. These are bullet loans. That's something that's good to mention to investors as well. So so they have 6 to 12 months is the estimated duration of the case, what they're listing at first base. So if the case resolves early, it's agreed out of court, is won, is withdrawn, whatever, then at that point, or fully paid, then you will get your funds back earlier. But if it doesn't, resolve within that 12 months. So let's say you put a 12-month maturity. If it doesn't resolve in that time, then the normal 60-day buyback kicks in. And then you will get the principal back at the same time with the interest. Interest is accrued as always on a daily basis. It doesn't provide the cash flows that normally this B2B does, but interest gets accrued. And I think this insurance plus the whole setup seems to be pretty solid. Now, in terms of bulletproof, I think the main risk probably would lie with the hypothetical situation that, for example, the insurance company would go bust, for example, or it would actually, or Sandfield would somehow fail as a company. What's good to note though is that the way it does that the entity setting up, if I talk a little bit about the structure, we still have a little bit of time, is that it's called SFC4 is the entity that borrows the money to there. So it's not Sandfield, so it's Sandfield's own SPV. So you could call it it's a ring fenced that only has these assets in there. And then this entity assigns the whole bunch to us, and then we assign it to the investors. So overall, it's ring fenced. It has an insurance backing, and it has a vetted law firms on the other side with vetted cases. So I think overall, the risk profile seems to be pretty good, and I think Sandfield will do very good with this business model.
Can you talk about their track record in terms of how many cases have they funded so far? What's their portfolio size? Those kind of metrics.
I will need to now take a look, to be honest, because I didn't check that so well. They don't have a massive amount of cases, but still significant enough for us to do our assessment. But yeah, I don't have the track record here now at hand. So,
well,
if you have some numbers,
I think I read something like I think it was 2,000 cases.
Yeah.
And the portfolio between 12, 14 million.
Yes. Sounds about right, yes.
Rough KPIs. From the communication I saw, they will be offered 13.5 interest rate. So
that is the discussion.
Relatively competitive. Also here, maybe the question, which volumes are you anticipating to come from them?
Again, I would say the same. If we can do short-term 1 million, we will prove a case that this type of a loan is actually attractive to our investors and that their profile is attractive to the investors. Again, if it's 3, we're happy. I think these guys have the opportunity to grow to even 10. What we hear, they're limiting also the amount of the law firms that they work with at the moment, because all the funding they raise, also out from outside of peer-to-peer or outside of platforms or platform like us, then pretty much everything goes. The demand is there, so they have a very good product that the law firms like. So hopefully as much as possible, but I would say if we do 1 to 2 million tests at start and get that in a short time, we're very happy with the result.
Obviously, it's always a little bit, I'm assuming, depending on the lender, obviously, but because you mentioned the commercial sense starting from 1 million upwards, don't you, prior having those discussions, set certain boundaries in the sense that, look, for us, it makes sense if you can navigate a certain range, a certain volume level, and just like go back and forth with this to understand or to maybe have a better projection also what they presumably could deliver in a year's time, in 2 years' time? Do you have this kind of element? Because it sometimes seems from your answer you can't really forecast how much volume it's actually going to be, which
Yes, I mean that's the thing is we've reflected in the pricing, right? So at higher volumes the pricing stops, so we have a tier system there, and at lower levels, if they're significantly lower than 1 million, then obviously certain fee structures like floor fees and others, they kick them also. So the cost of funding for them is also, so it's not just that it's not for us commercially not very interesting to do anything under. but the cost of funding is also for them very expensive, or let's say expensive, not very, but still like much more expensive than on larger volumes. So this is the kind of the way we also try to guide them to prioritize us, because they get cheaper funding the higher the book gets, because euro to euro, it doesn't necessarily cost us as much to manage a book of 5 versus 3. So that's one point. The reason why I'm always a little bit hesitant to say how much is that, in the past we've seen companies tell us that, oh, we're going to go to 5 million, here's the projections, and then they can't get there. They go to 7 million or 700,000 or something like this. And then, what happened to the 5? Well, something happened, or they run out of equity to grow to that level or whatever. So obviously we would like to see, I've said it before, if we can get 10 LOs, which each 10 million, we're very happy at 100 million book. I would prefer that much more than having one at 100 million because of the concentrated risk. But we can't really, these are third-party entities, their plans change. The best we can do is try to guide them, and then through the funding or through the pricing. And that's why I always give it to like short-term 2 to 3, and then hopefully up. Depends also on investors, right? So obviously, if there's no demand, then we don't really, we can't say. But we're trying to find companies that investors would find interesting. And I think, looking at Sandfield's profile, I think it'll be an interesting one for sure.
Quick question, and please quick answer, because we need to wrap up in time. Now with Ibancar, Sandfield Capital, will there be more lenders coming this year, or was this about it for 2024?
I think this was about it. We have some discussions, but we are not very far with anyone else at the moment. In that sense, we do have a few good prospects where the discussions are ongoing. If a miracle happens, we'll probably onboard still this year. And it depends a lot on our new LO onboarding manager, Yegor, how much he can actually pull new leads in. But I think, again, we have quite a bit of supply on the platform in terms of, so there's no cash drag for sure now. That's for sure. We're shifting a little bit again to the other side and saying, like, how do we get investors to fill the supply? And then, so we're not in a hurry with new ones. If new ones come, awesome. If not, you won't catch me with a broken promise.
All right. Good way to end up the episode. Just a quick reminder, next episode is going to be a Q&A session. Please watch out for the link in the video description, also in the Telegram chat. And then we're going to answer your questions in the upcoming episode. Kimmo, thanks for your time, and until the next time.
Very good. The next time. Thank you, Denny.